let's go to Tesla, Harold. It's down 2.3% here, falling below the 50-day line for the first time in quite a while. As it pulls back, it had this gap down on earnings. So it's continuing to digest that. So, talk to us about how we might look at this from an options perspective.
Yeah, so with Tesla, I'm looking at an iron condor now. Before the market opens, it was above the 50-day moving average, and then you had the 21-day moving average right on top of it. So that's what prompted me to do the iron condor because it could move up, hit the 21, and kind of stall, or it could break down and get down below the 50-day moving average. So that was my reasoning for the iron condor because it's Tesla. It can be all over the place, and an iron condor is a neutral type of trade where you expect the stock or you want the stock just to stay in a small trading range. So that was the reasoning behind it. So let me get set up here. All right, so I'm gonna share my screen.
Great.
All right, so you should be seeing my screen here. All right,
Yes.
so All right, so we got Tesla here. So I'm going to go out to the September 15 expiration, which is about 39 days out. So I'm gonna hit that, and then we scroll down quite a bit.
And just a quick question there, because I feel like you like looking around 45 days, or was one 46 days, but it was a weekly. So do you prefer
Yeah, yeah,
monthly?
I prefer the monthlies.
Mhm.
So I'll take a look at the weeklies. I didn't do it with Tesla because earnings are out of the way. 39 days are out. That's a pretty good time. 74 days, that was a little bit too
Yeah,
far. So I said, let me
perfect.
just go with the 39-day expiration.
Sounds good.
Yeah, so we're 39 days out. So I'm going to start with selling so on the put side here, I'm going to sell the 230, hit that, and then I'm going to buy the 225 for protection. All right, so that's the puts. And then on the call side, I'm going to sell the 280 and then buy the 285 for protection there. All right, so here's my setup. Got a credit here. So I'm gonna load this because on the numbers I've got on the left side, it was based on a credit of $2.20. So that's our credit, $2.20. So let's take a look at the numbers. I click on confirm and send. And the first thing I like to look at is my break even. So this is my break even, 227 to the downside, 282 to the upside. And by the way, you can use these break evens as stop losses also. So my max profit is 220. Now let's take a look at our probability of success and how many contracts we're going to buy based on the numbers we're seeing. Let me close that. And then on the left side here. So I've got my probability of success. So the first thing we need to do is find out how much money are we risking? So to determine that, we take the width of the spread, which is $5. I don't know where that character came from. So the width of the spread minus the credit received, which is 220 cents. And then that's going to give us a actual risk of $2.80, or in option terms, 280 bucks. So that's our actual risk, which is $280. Now, to determine what the probability of success is, we take the actual risk, which is at 280, divided by the width of the spread, multiplied by 100, and that's going to give us a probability of success of 56%, which is kind of normal for an iron condor. Prefer higher, but iron condor, since it's such a neutral trade, your probability of success is not going to be real high. All right, so return on risk. How do we determine that? So we know we're putting up $2.80. We take that and divide it by the credit received, which is uh, that should be 220. About that. Oh no, that was right. 280 divided by the 280 bucks, and that's going to give us a probably a return on risk of 78, about 78.5%. All right. So how many contracts are we going to buy? So we determined that we're going to, based on our portfolio size, our level of risk, $2,500 is what we're going to put up. So we take the $2,500 divided by the actual risk, and that's going to be, which is $280. So that's going to give us 9 or 8 contracts. Let's just go with 8. So I'm going to change this to 8. Oh, and by the way, before I get to do that, how do we manage this trade? So with the iron condor, since it's a neutral trade, you got a low probability of success. We're going to do 25% of the actual credit received. And then again, as I mentioned earlier, the uh, the break evens, that's going to be our stop loss. And then 21 days to expiration, that's where we're going to make a decision as to what we do with this trade. Are we going to just close it out for a profit, or are we going to roll it? What are we going to do? So that's how we're going to manage the trade. So let's change the numbers here to the contracts to, we'll just go with 8. And then let's take a look at our numbers, hit confirm and send. And then here's our number. So again, there's our break even, and then our max profit, and then the monies that we're putting up for this trade here. All right, and I'm gonna send this off. Click on send, and hopefully we get filled on.
Great. Thank you, Harold. And now I'm going to go back to MarketSmith and just show the approximate break even levels on the chart. So, do you want to talk to us about how, you know, it gives you room on either end? And it seems like they're at pretty logical levels.
Right, right. Yeah, and that's the great thing about this trade. You see to the downside, you've got that gap over there to the left, just to the left of that 240.70. So you've got that
Mhm.
that gap there. So hopefully Tesla will find some support at that gap. And if it goes the other direction, we've got that high, which is I don't know, yeah, right there, that gap down. So you got two gaps providing support or resistance here. So uh, hopefully Tesla is going to stay in between these two areas here.